So I think the beauty is to be confronted with other social aspects like the aperos which are taking place, which are a great pleasure. So welcome to our panel, Social Investing Engagement, What to Watch Out For. Let me share first maybe some thoughts to set the context for the next 40 minutes. Increasing inequality destabilize economies and societies. Rising inequalities fighting is not only the job of NGOs, governments, central banks, companies, but also investors. That's a subject we will address together as well. And we believe that after climate risk, social inequalities will be the next major issues for investors and societies in general. With this, I would like to welcome at this point our highly decorated panel. Really pleased to have you here. We have maybe starting with Claire Ahlborn, engagement specialist at Robeco. Thank you for flying in or riding in by train, even better, from Rotterdam. Then we have Lydia, Haueter, Senior Investment Manager, Thematic at Pictet, and we know you do that particularly successful. Very pleased to have you. Then an old colleague and friend of mine, Ben Kelly, Director of ESG and Impact at Columbia Threadneedle. Lovely, you found your way back from Mauritius, I learned. Great. And Louis Stevens, last but not least, has Sustainable Products at Liontrust. Greatly pleased to have you here today. My name is Christian Trixl. I'm CEO of Amundi Switzerland. So I will give you some substance with 1-2 slides just to set the context of our conversation today before we dive into the Q&A. So where do we see the challenges of global inequality, which is a broad subject for us all probably as a fair point? When you look on this lovely demonstrated elephant curve, you see that almost over 40 years, between 1980 and 2080, the dispersion of global growth, we had global growth, that's a good part of it. But when you look into the middle part, you see on the horizontal axis the income group, and you see on the vertical axis the real income growth per adult of this income group. So the good bit is we can say that the bottom 50%, divided in the middle here, had a rise. That was mainly driven through the raising wages and wealth in emerging market, but this only captured 12% of the growth totally. On the right-hand part of the chart, you see here this peak, which is top 1%, captured 27% of the global growth. And here you see the squeezed out bottom in the US and Western European part of this world. So you see a clear demonstration that the global wealth and income distribution was fading into the direction of the top 1% and left the other one with a minor part of this lion share. When you look on the inequalities are becoming a macroeconomical and political issue, we see it here in the example of Chile, the demonstration, social unrest, increasing taxes, public transport costs, which had a major impact on financial markets, which dropped at this point minus 15%. Based on the MSCI Chile index. But we see also the social unrest which is taking place in Europe with the Gilets jaunes in France, for example, but also the recent more dramatic example of harmful demonstration during the pandemic crisis we have seen everywhere in Europe as well. So social unrest is an issue which is existent and is mainly driven due to the perception of social inequality. What is said, and that's an interesting element when you look on the recent research from the OECD, and I don't have to explain you the Gini index, which is telling us when you decrease the social inequality measured on the Gini index by 1 point, it will drive growth by 0.8% GDP growth over the next 5 years. And that's a major element which showcase also that a decrease of social inequality will help to make societies and also economies growing as well. And when you look on the point here at this politician, even the US is capturing the point and thinking severely about household taxes, inequality of household taxes, and also in terms of share buyback programs of corporates to make the rules more restrictive, to give back to society, and we will see why. Because when you look at this left-hand upper chart, income inequalities, CEO payout ratio, which was measured back to 1980, the multiple was the ratio of the multiple was 42, so the lowest earning wages in comparison to CEO, which increased by 2080 to 287. So it's a major gap which was opening up, which was also bringing famous people like Jeff Bezos under pressure. Here is a Twitter done by Dan Bartlett, the CEO of Walmart, which asked Jeff Bezos also to pay his taxes. Now, why is the background of, especially also in the retail sector, but also easily translatable in other sectors as well, that it showcases very well if you treat employees right and fair, there is a greater productivity, which is in terms of cost reduction by limiting turnover, which is massive. Here in this case, on the S&P 500, it's 12%. Greater productivity means easily 600 billion more of growth. So that's, with this, I would like now to dive into the Q&A. We have certain zones defined together, which we'd like to address, which will be around the substance of having a conversation, what it means, social framework, how should we understand that? Then we will talk especially also about the investment and investment opportunities in this space. We'll touch about regulatory issues and finally also address a bit of the future as far as we can see, and greatly pleased to have you with us today. Now, let's first think about one thing which I think is a major obstacle in understanding. I mean, social issues usually covered by governments and NGOs and mainly also taxpayers' money. What are actually investors? You know, what is the job of investors in this space, and can it also lead to a certain direction which is uncontrollable? And having you with me, can I start with this question?
Absolutely.
With you?
So there's two things, right? So first of all, you have the social issues within a company. So how does a company treat its employees? How do they pay them? Is there a gender pay gap? There you can do a lot with engagement, right? So you talk to the company, you try to get these kind of lower hanging fruits to work out, and usually that doesn't come at a great cost, because it's not harmful on a cost or EPS basis to have more women in the workforce. On the opposite, actually. So that's one part. So engaging with the company on better conduct. But the other part is actually what's the footprint of what the company is doing on the world, basically. So the products and services, do they have a positive impact on society? And there it's really about choosing business models that are not harmful, that actually have a positive impact. So there it's not really, you're not going in and engaging with the company to change their business model completely. That's, in my opinion, actually quite a hard thing to do. So it's really here at asset allocation to the good players in the field. So that's how I think about it.
Good. And when you think about, we are talking about mainly companies, you know, is it enough to turn the wheel in the direction of societies as well?
There's certain things. So I'm coming from a healthcare perspective, right? I'm an investment manager for a healthcare fund. And here you have certain interests or incentives that are very entrenched and that are very opposite to what actually society would want. Let's take the healthcare system in the US. You have, for example, incentives for drugs to be more expensive because doctors make more of it, companies make more of it, insurance companies make more of it. So there's like entrenched business issues that it's hard for investors to change these. So there probably you need a regulator that is helping you. But when you select businesses that already are placing themselves to be better within that system, you will have the winners once the regulation is coming, right? So you basically avoid regulatory blowbacks. Within healthcare, for example, it is value-based pricing for drugs. So it's not paying for services, it's actually paying for the outcomes that you get in terms of patients feeling better, right? That's one example.
Mm-hmm. That's a good one. Mitigating risk as well for investors at the same time.
Yeah.
Coming from Rotterdam, Claire, what's the view of Robeco about social impact and the framework, especially also in terms of substituting government and NGO, which is mainly their job, you know. Do you think investors is not a bit like a top-up which is more incentivizing investors to make profit out of social engagement?
Yeah, so I think overall it's a very collaborative effort, and like the whole debate with climate change, not only governments or only NGOs or only civil society can do it, but it's really a collaborative effort. And I think in terms of how we perceive it at Robeco is more that we look at it really through this double materiality lens. So on the one hand, we have, as investors, we share the responsibilities that companies' actions have on society, but on the other hand, there's also, of course, the impact of society on our investments. So I think, at least from that perspective, even if you argue against or just for profit, I think it just makes even business sense that you also have to look at how a company is prepared to mitigate certain risks, but also then, as Lydia already mentioned, that afterwards they're really positioned to be in a strong position once regulation comes in. So, and that is also where we then bring in our whole engagement. So that on the one hand you can understand the risks that a company faces, how they're addressing them, but on the other hand you can also nudge them to be more receptive to certain risks, and as well as share certain trends that we see across our other investee companies, etc. So it's really this combination of pressure points that we consider.
That's an interesting aspect. I mean, pressure points on companies to behave better and improve themselves. But looking from the lens of being fair in this context, and we recently, actually we have it this week. Credit Suisse announced their first quarter result, which were, I don't comment on that, but. Actually, they go through a tough time. But actually, there were a lot of shareholder activism, but more on the side of climate, of full exposure, etc. And the thing is, can you be fair? Can you be equal? Having some sort of lack of regulation. I know, Ben, you did a lot of work in this space. How do you feel? The point of fairness is coming through as an investor. Is it in equities or debt of a company? Is there a line you can see which is clear enough for identifying?
Yeah, I think from where I sit, so I work quite closely with our social bond franchise at Threadneedle, and the reason we started those was essentially to provide positive social outcomes, and we think the bond markets are actually quite well placed to provide social impact. The problem is, though, well, it's not necessarily a problem, but traditionally when you view ESG as a group, everyone's very focused on the environmental aspects. And, you know, in our funds we hold airports, and people say, why on earth would you hold an airport given the environmental issues? And I do like aeroplanes. I wanted to be an airline pilot, so I'm quite happy to talk about aviation. However, I believe that there's huge social benefits by owning regional airports, linking communities, providing valuable medication, food, etc. And we saw that come to the fore during COVID. And I think COVID has actually catalysed momentum behind the social. The pandemic was a social issue. We're going through another fairly large social issue right now in the Ukraine. And what we've seen in terms of issuance in specific use of proceeds social bonds, so these bonds that are issued to fund specific social projects. During COVID, the first 3 months of COVID, $90 billion of social bonds had been issued around the world to fund pandemic relief programs. To put that into context, for the previous 9 years, $30 billion of specific use of proceeds social bonds had been issued, so a huge increase. And that momentum has essentially kept on going since. So it's been nice to see social not be regarded as perhaps the poor relation in all of this. Clearly, the environment is very important. But I think slowly but surely, people are starting to consider social aspects. It's not always easy to kind of capture the data in terms of how you think about improvement. But I believe that the bond markets especially are very well placed to kind of deliver that social impact. I'd like to give you one example of the kind of shift we've seen recently. Before COVID, people would come and talk to me about should I issue a green bond? And even companies that perhaps, where their products and services were socially aligned, didn't really get the social aspects. I had one meeting with a pharmaceuticals company, and they said, we're going to issue a green bond, Ben, and we're going to fund solar panels on the roofs of all our production plants. And I said, that's very nice. Have you ever thought about issuing a social bond? And these two gentlemen looked at one another with fairly clear-cut expressions. And they said, I don't think we've got anything that would kind of justify a social bond. And when you think it's a pharmaceutical company and their business is hopefully treating people who badly need medication, and they couldn't think of a social aspect, that was slightly concerning. But once I'd highlighted the fact that that's what they did, they seemed more open to it. And I think now I'm having a lot more conversations about, well, I'm not going to just issue a green bond. Should it be green? Should it be social? Should it be a sustainability bond? Those are the conversations we're having. So I think we are making progress. And obviously the pandemic was a devastating period for us all, but that has been a positive to kind of spin out of that, I think, the fact that we are more attuned to the instabilities in the world, and we are trying to do something about it.
That's an interesting aspect. So you think the world is getting better in terms of...
I'm always a glass half full person, so I'm always inclined to say yes. But I think whatever strata you're looking at, whether you're talking about governments, corporates, and ourselves as investors, I think everyone's more aware of the fact that we need to do a lot of work to kind of stabilise the world, as it were. And it's not just about the environment. If we get the environment wrong, it'll be a huge social problem. And I see the environment and the social quite closely linked, to be honest. We're doing quite a lot of work on the just transition. So it's great to transition businesses to renewables and decarbonise, but ultimately you don't want that to be at the expense of thousands, possibly even millions of people around the world losing jobs. There's a city in northern Scotland, Aberdeen, that was obviously very central for the oil business, and they've gone through a pretty rough time over the years, given what we're seeing. So it's important that the cost of this transition isn't bared upon by the most vulnerable people in society. And how do we help those people who potentially could lose jobs through this? How do we kind of re-educate those people and keep them in the workforce? So that's something that plays on my mind a lot, and something that we engage with companies a lot.
It feels very interesting to see on this journey that apparently to finance corporate, respectively government debt, seems to be more clear. A space where you can find spots of engaging yourself in a social manner. Corporate seems to be more like corporate equity, shareholder activism conversation. What's your perception there? Louise, you said that the world is getting better. That's a good thing, so apparently it goes in the right direction. But But how do you feel? Do you find the right investment opportunities out there in the world to?
To your point, actually, we agree. Actually, we're eternal optimists at Liontrust, and we view the world. We do think things are getting better, and in spite of regular news flow, if you look back over decades, even centuries, there's some really great examples of huge positive societal change. So to give you an example, at the turn of the 20th century in the UK, the amount of children that died before the age of 5 was 1 in 5. That's more like 1 in 300. It's unimaginable, given that rate of change. If you look at urban air pollution in London, where I live, that's had a 20 to 30 time improvement. Now, what we're not saying is these are necessarily where we want them to be, but these are demonstrating really big changes and massive societal positive changes in the world. So, for us as investors, we think this is a really interesting opportunity. When you think about how that change has happened, yes, you've had scientists identifying issues that we established. So in urban air pollution, for instance, yes, it's very bad. How do we, lay the groundwork for change? Well, governments, NGOs come in, they lay taxation, regulation, and then it's often businesses that operate and opportunists to make the most of that change and provide the solutions which help catalyze and accelerate change. So when we're thinking about the investment opportunity that really comes out of this for us, as well as engaging on these societal issues, and we really think through the world in sort of 3 key areas. So we look for a multi-thematic investor. So we're looking for companies that help us become more efficient as one sort of silo. The second silo, which is most linked to really positive sustainability, social issues, is improving our health. And consumer-facing brands, for instance, healthcare companies. And then the final is around more greater safety and resilience. So that sort of second key silo is really searching for those companies that are delivering products and services that we need, and as a consequence are growing exponentially and helping solve these issues. So we think there's really strong alignment with societal positive change and investment.
That sounds great. Now, do you tend to buy the label, or I've heard also that the data is probably also something which is on the journey, because you cannot factually rely on the same level of sources of the data. Now we are talking about global equities, we are talking about emerging market equities, we're talking about also less liquid zones like infrastructure spaces which are helping society as well. We are talking about company engagement in itself, which are vague to measure and compare with. How do you handle that at Robeco?
Yeah.
Claire, this challenge.
I think that it's definitely a challenge that is high on everyone's agenda, and there are just not these one criteria or one kind of thresholds that we want to get to, like in the climate debate. But of course, then you have these underlying minimum standards, like the ILO conventions, etc. But it's just often very difficult, as you're saying, to measure and to really put and also get in transparency through these very complex supply chains, various different actors that are involved, as well as then external stakeholders, communities on the ground. So it's just, that is something that we consider very challenging. But on the other hand, it also is not an excuse not to act. So perhaps just reflecting a bit on how we conduct our engagements. Generally, we create a very strong baseline research on the issues that are there, that our investment teams and our clients flag to us. And then we look at the best practices that are out there, as well as compare the different companies that we want to engage on exactly these, on the one hand, high, like controversies, what is the general practice, but also the underlying policies, what might explain this, as well as underlying processes. And then we really try and have these tailored indicators to just measure the process of our engagement and be able to put forward very clear demands. So I think on one hand, it is a very qualitative process, and then sometimes you have these very meaningful proxies which can be used also more overarchingly. And then one example I think is a very interesting one, and was we have in the past been involved on the living wages in the garment sector, where we've been engaging, and there we have been participating in this platform for living wage financials, which is a collaboration between investors. And there I thought it was very inspiring, because the investors really came together and created a scoring for themselves. So it was a collaborative effort. Everyone covered certain companies, and then really went in depth, comparing all these companies across all the investors. So he had a very much broader reach, and it was also a third-party audited assessment process. And then we were able to use these KPIs or these assessments and then engage on it. And then also, of course, share it with other investors, etc. So I thought that was a very inspiring little example of how also investors can contribute to more transparency or set also these KPIs or metrics that we're looking for.
That's interesting indeed. In a thematic space, it might be easier in a certain context. How do you think about when investors are coming to you, Lydia, and do they majorly focus on the theme you're offering them?
Yeah, it's still very much tailored to growth. So the story is all about economic growth, and that's why these themes outperform. So it's not really the impact that people come with. But obviously these themes are growing structurally because they are in future bringing fields. They have business models that will survive through regulatory change, and that does not harm society. So we do exclude certain things. We look for positive impact, but it's not easy to define the same for every theme, right? Because you have from robotic, like automation, you have biotech, which is like drugs, then you have human, where you have things like loneliness, where you have, for example, dating apps. And so it's really hard to find one single framework to capture the impact for all of these. But to me personally, how I think about this is really about incentives, right? So you need to think about incentives for the management of the companies, say the CEOs. Do you want to pay them only on EPS or on stock performance? No, you actually want to bring in something like maybe how many patients have you treated, or just social metrics that they are being paid on. But then also for us as investor portfolio managers, right? We are paid on alpha, purely alpha. That's currently the industry standard. So if you as an investor in the funds want us to focus on impact, ask how is the portfolio manager incentivized? So is it just purely on our performance, or is it also on like social metrics and impact metrics? So really it's all about incentives and also in investments. So how much does a company actually invest in people working on this? And here for me, just because impact is so specialized depending on which theme you're in, you actually would need an impact specialist within every investment team. That would be my ideal world. It's very too expensive. But actually, I think that would be a perfect alignment, because then you have the deep investor knowledge paired with the impact world, bring the two together. So I think that is kind of where the industry should go in the future, but it's a cost question. Yeah.
Very interesting aspect. So when, Luis, when investors coming to you, are they more target-orientated or outcome-orientated? Meaning, are they more buying into this social investment idea due to the fact that they expect an additional return on the back of that? Or are they more like good doing in terms of the target is to help society to become a better society?
It's a great question. It's the whole topic of this is very nuanced and sort of, I suppose, difficult to answer. So for us, obviously I mentioned earlier that we have this multi-thematic lens, and a lot of it is about growth, but clearly we want to try and show positive outcomes where possible. But it does become really difficult. If we use an example of an investee company, IQVIA, which is a US-listed company that helps speed up clinical trials for drugs, with the impact of what that's had in COVID, for instance, they've had huge social outcomes which are really beneficial. How do we measure that? It's very difficult, and let alone at the aggregated level, at a fund level. So what we do is mainly through qualitative research, talking to companies, we try and show case studies to try and show investors the positive outcome of their investments. We also believe actually in terms of engagement work, a really positive area for where we can all work together is on notions like the Workplace Disclosure Initiative, where investors are asking similar questions to companies, hopefully getting more consistent data sets across different strategies from different firms. So it's very difficult, and for us, unfortunately, it's more an outcome of how we're investing, and we try and get as much information as possible, but it's always limited at this stage, and I'm sure that will persist for a while. But, we hope that improves with time.
Interesting. Ben, the world is moving forward, huh? And we see, especially on the climate side, on the green bond side, on PHE, Paris Aligned Agreement context, we see indices adapting, especially on the climate side, but we haven't really seen anything on the social side yet. Is there, because the world of investors is not aligned yet, or what's your point of view? Because I could imagine also, given the fact that more and more investors are willing to look at this subject, that the market in itself is not offering enough, which will automatically build some premium, which is probably not that helpful for investors again.
Yeah. On the social side, I think you're right, Christian. They are a little bit behind the curve in terms of being able to produce the products that investors want. I think when I think about the future in general for impact, I'm glass half full, but I'm pretty positive on the momentum we're seeing. And if you bear with me, I'm going to detour slightly here, and you'll think, what on earth's Ben going on about? But hopefully I'll get to a conclusion where you kind of understand where I'm coming from here. The last 6-7 years, when you think about environmental aspects, social aspects, it's been focused on good operating practices of companies. And if you're an active manager and you've been focusing on these things, there has been an alpha advantage by doing that. Some companies want to improve willingly, and one of the key things I always look for is the kind of intentionality that a company brings to the table. But there's other companies who are just being forced to improve through regulation. So whether you like it or not, metrics are improving, our ability to kind of track this with meaningful KPIs is improving. But as an investor, my ability to extract alpha from this is probably decaying as everyone improves to a similar kind of level. And I liken this to what you see in kind of professional sports. So whatever sports you look at, I spoke at a very long panel 3 or 4 weeks ago that lasted 6 hours. It wasn't just me talking, fortunately, but it lasted a while. And I got on to, it was Spanish and Latin American, and I started talking about this football team in England called Preston North End, who have the record for the highest score in any given football match. So it's 26-0, which was about 110 years ago. And the point being, what any sport you look at 110 years ago, you can scour through the charts and there's loads of records, because the kind of spread of difference, or spread of excellence as it is, as I like to call it, was quite large. If you were very good, you could be competing against someone who wasn't very good. But today, professional athletes train better, they have better diets, they get feedback on data, and they improve. And you put a Roger Federer 100 years ago, and guess what? He would do an awful lot better than what he does now, which is also very impressive. And I see in active management, it's a similar kind of thing. That spread of excellence through time narrows because we're all learning, we've got better data, we've got better access to this. And the next leg for me, when I think about responsible investment over the next 5+ years, and particularly with social, is this focus on impact. And I think that's the next leg of this. We're not there yet on the social side. It's lagging the environment, but I think we've started this journey now, and I think it will continue. Like the crisis we have in the Ukraine, the nice thing about the bond markets is that they can respond to these social crises quite quickly. And the Council of Europe Development Bank issued a bond last week, $1 billion bond supporting member nations cope with the refugee crisis that these countries are facing around Europe. And that's terrific that you can act so quickly, and investors like ourselves can benefit from that and contribute to better outcomes in society. But it's not perfect right now, but I think we're going in the right place. And thanks for letting me waffle on about.
No, that's very
I hope
interesting.
you're not a Preston football fan.
No, I'm Blackburn actually, which was which is even worse. Yeah.
I like the analogy of these football teams. No one knows probably in 1,000 years. But we love them.
I know.
Yeah. Being mindful of time, we have 35 minutes past already. It's absolutely refreshing and fruitful. Just maybe to you, dear audience, may I open up to questions you might have at this point? Yes, Sona, please.
I don't have a question. I just want to add, because I just finished a research project on like NGOs and the Bangladesh Rural Association community, or it's called BRAC. Anyway, it's the world's largest NGO, and it was set up to be a for-profit, and they're doing amazing work. So just to point out that the world's largest, one of the most successful NGOs, is actually set up intentionally for-profit. So the two go hand in hand. I just wanted to bring that to the attention so that on. And I think it's shifting from, all this lingo is coming more towards like inclusive finance and stuff. And the ES and G are so interlinked. And I think we need to be very careful because you can't have the one without the other. And I think that's becoming increasingly clear. And so just, another example is like the Congo Basin, where they have special efforts now to protect the Congo Basin. And they've got trees that they can use guitars. So it's serving the environment and the social, because they're creating employment. So there's lots of positive stuff like the world now. So no questions, but just that, it's all there.
Thank you. Questions? Anything else? No.
What was the coupon on that bond that was issued last week?
The Council of Europe one, it was... I've been away, but I think it was 65 basis points. Because it's a development bank, it's not great. My big issue at the moment with potential greenwashing is these things called sustainability-linked bonds, where there's no real impact attached to them at all. It's a great... So what companies do, they can issue these bonds and they can say, over the next 5 years, we're going to reduce our emissions by 30%. And you go, okay, that's quite good. And then you look at what they're doing anyway, and they're already well on track to doing that. And if they don't achieve it, they get a step up on that bond. So I've been slightly sceptical of a large number of those. I had a meeting with Carrefour not that long ago, and I asked I don't think it was the head of sustainability, but it was someone who worked in that team. I asked them, have you not thought about issuing a green bond? And they just looked at me puzzled, saying, we don't understand the question. And that was slightly concerning. And then when I looked at their targets, I think they had a Scope 1 emissions reduction by 2030, I think it was like 60%. And then you look in their sustainability report, and their actual target is about 85%. So it's not even doing what they're saying in the report. So that didn't fill me with a lot of pleasure, to be honest. And we didn't bother investing in that. But I think that's where the real potential issues could arise in sustainability-linked bonds.
Well, I did have a question now.
Oh, dear. Sorry.
I'm just thinking, because I thought about this all the time, and when they say, solar panels and stuff, I'm trying to understand what's the math behind the real cost of production, right? You think coal is bad. Okay, of course it's bad. But nobody thinks through, like the solar story, right, with the metals, and then discarding it and all of that. And so what I'm really missing over and over again is this transparency or this level of, because in the short term, it looks glossy, it looks believable, but I don't know, if it really is. So my question is are you guys looking at the way it's sort of broken down and how you tear it apart and the real, E, the real S, and the G is given because that's the governance thing. But that's a question I have, because I'm struggling with that. So I couldn't tell, the sheep from the woods very well. So have you guys done work on this?
So we actually have a framework that's actually looking at the whole supply chain. So it's not just the company itself. It's called planetary boundaries. And what we look at is basically things like biodiversity, CO2, what's the safe operating space of a company, and in what space can it be without having a negative impact on the whole society. And so you don't just look at the product itself, but actually the whole supply chain. We're doing that with an outside consultancy, but it's really factoring all that in.
Because I think that's where...
Yeah, definitely.
Yeah, perhaps from the engagement side, and I know it's a slightly different lens, but it's such an interesting debate. And there, I think, so this year, or last year, we launched an engagement topic on human rights due diligence in conflict-affected and high-risk areas. And one of those areas and industries is exactly the solar industry in China, in Xinjiang, where there's so many human rights controversies and issues, of course. But it is so often such a challenging topic to engage on. So that was really one of our biggest questions in the beginning. How do we even approach this topic? But because it is so essential, and we can't have exactly a sustainable future and sustainable technologies and energy if we have these huge social as well as, of course, environmental challenges there. And so here, just in this engagement theme, the approach we took was really to focus a lot on encouraging companies to build up these human rights due diligence processes, to have the right policies in place, to first of all acknowledge the issue is even there, have right policies in place, as well as then afterwards assess the impact that they actually are having and how they're then dealing with these business relationships, because often it is really further down the supply chain, so often they don't have the exact oversight either. And then I think one very important topic is, of course, also remediation. If there is an issue, what do you do with it? And how do you also perhaps responsibly stop a business relationship, and how public can you be about it? So it's a very interesting topic and something, there's probably no easy solution to it, but I thought it was a good example.
It's a question to all of you. We're talking about bonds and equity. What about real estate? Being invested in real estate, affordable housing, etc., has a huge impact in environment and social issues. Do you have any experience in that? Do you see any future in this as an investment?
I mean, personally, we're mainly listed equity focused. We do have our bond funds, which I'm less familiar with. We do have bonds such as Places for People that, focus on that sort of real estate aspect and providing, affordable housing, for instance. We're not a real estate investor per se, so I probably have not too much to add to that, but I'm sure some of my other panelists may do.
Yeah, we recently entered this space, but I have to say I'm not very familiar with it. I'm an equity person, but I know that we are actually entering real estate. But not sure what they do in terms of impact, reporting, etc.
I don't sit exclusively on the real estate team. I do sit on, they have an advisory panel, which I do sit on. And they are striving to do quite a lot in terms of, on the environmental side, obviously improve the footprint, get the correct certification for the buildings, but also they're trying to do quite a lot now around social, so we're having frequent meetings in terms of myself trying to help them think about how to go about it from a social perspective and things like just trying to understand who your tenants are and what the line of business they operate in. I think is really important. How the companies treat their employees is also important. Like when we have meetings with these corporations, it's not just about what's the pay of the CEO, etc. It's about how do you pay the most, the maintenance staff or something. Like I had a meeting with a university who had issued a sustainability bond, and the bond looked great, the use of proceeds looked great, but I didn't bother asking them how much their vice chancellor gets paid, because they're pretty well prepared for that, but they're perhaps less prepared to talk about how much their cleaning staff get paid, what is it in relation to a living wage, etc. And that can be quite insightful, and I'm trying to work with our real estate team to kind of give them examples around that, how they can improve it. So I think real estate does have a big part to play. I think the private side in general has a big part to play. On the bond side, more so in the UK rather than Europe, but we're quite fortunate that there are a lot of housing associations that issue debt in the UK, so our UK Social Bond Fund takes advantage of that, and they're a mixture of very high impactful bonds dedicated to social housing, and then some housing associations who are more interested on kind of development work, which is, in our eyes, not quite as impactful. So you've got to be discerning in that space, but I think across the board, you've got a huge opportunity.
Everything still okay. Good.
There was in fact, yeah.
Great. I think our time is done. Thank you very much for joining us, dear audience. Thank you very much, Lydia, Ben, Luis, Claire, for joining the panel. It was a great pleasure. And hopefully see you soon again. Thank you very much.